Okay. Okay, let me. Oh, okay, let me get. All right. All right. There we are. And is this visible?
I'm not seeing, we're not seeing your share screen.
Okay, let me yeah. Share my screen. Okay. 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 Can you see it now?
Yep.
All right. Well, today, folks, I'm pitching for Miss Charmaine Davis, who will be joining us at another time in the program. So I'm pitch hitting today, and I just wanted to take you through a couple things that she's laid out for me to do in terms of just today's objective. So define the accounting equation, examine the financial statement and supporting accounts, evaluate GAAP versus cash basis, and hopefully we'll get down to the sample problem. All right. So the fundamentals. Let me get this right. All right. So the fundamental equation of accounting: assets equal liability plus equity. So assets is what you have, liabilities is what you owe, plus what you own. And so that's the equation. Assets equal liability plus equity. That's the fundamental equation of accounting. Again, assets is what you have, liability is what you owe, and equity is what you own. Okay. The balance sheet. The organization financial situation at a particular time. So what your balance sheet shows you is where you are financially at a certain point in time with your assets and your liabilities. So it shows the assets equal to total liabilities plus the equity, hence came the name the balance sheet. Examples of assets are cash, accounts receivables, prepaid expenses, inventory, investments, land, building, furniture, and equipment. So let me ask a question to sort of get a sense of your knowledge on terms of accounting. I assume that has anybody worked with a bookkeeper or accountant before? Show by just showing your hands. Okay, so you have a basic understanding of accounting and what goes into accounting. All
Yes.
right. Okay, good, good. So it makes my job a lot easier. So again, example of assets are cash, or accounts receivable, prepaid expenses, inventory, investments, land, building, furniture, and equipment. Normally the things that comprise of the assets of a business or organization. Okay. Examples of liabilities are accounts payable, accrued payroll, deferred revenue, accrued interest, member deposits, loans payable. Can you think of any other examples of assets or examples of liabilities?
No, but I have a question about member deposits.
Yes.
So in a cooperative environment, when your members put up their money, how is that a liability?
Good question.
Is
Because
that
I would
because
I
you
would
owe
say-
it back to them or something?
I see it as I would see it as an asset, but I assume that in terms of the example of a liability, I imagine because it's being deposited and it's being recorded as a member deposit. That's the only thing I can come up with.
Is it due and payable back to the member at some point? Is that what makes it a
Well,
liability?
that certainly would make it a liability if it's a repayment on it in terms of deposit. But I would say put that as a question to ask Ms. Charmaine Davis when she comes in the room, because I don't know what
Okay.
her thinking was around that member deposits.
Okay.
But it could be, yes, if it's being paid back to them, it could be a liability.
Okay.
Elizabeth asked a question in the chat. She asked if a lease is considered a liability.
Is what?
Is a lease considered a liability?
Let me go. At least, is at least considered a liability?
Yes.
I would think so. I would think so, because it's a payout. It's, yeah. So it comes under accounts payable. So yes, I would consider lease being a liability.
And deferred revenue, are these funds that eventually will be paid out? That's what makes them a liability?
I would think so. Because they're deferred, and which means that eventually you have to pay those revenues out.
Okay.
And so they were coming under the heading of deferred revenue.
And I have another question too, because if you like under assets where it has land and buildings, which is considered a part of real estate, right? If you technically don't own it outright and you still like have a mortgage on it, it's really not an asset, not unless you are accruing some type of
Equity.
It's a liability.
right, exactly. So
Yeah,
if you're
it'll
not
be a liability because you have to
right,
pay. You're making payment on it.
right, and if you're not accruing much equity in it, like where you can go and get equity out of it in exchange for either more property or for more investments, then that's what can make it an asset. But sometimes if you're not using it that way, it's more of a liability.
Okay.
If that makes more sense.
Oh, thank you, Kimberly. Thank you. Thank you. So equity. So we again, assets, liabilities, and equity. That's what the accounting principle is based on. And so equity is retained earnings, member shares, certificates, or capital contributions. This is equity in return is not automatic when the member leaves the co-op. If the return is automatic minus any non-payment of charges or damage assessment, this should be recorded as a liability. So member shares and certificates are looked at as equity because they're building a return, but it's not automatic when the member leaves the co-op because they have to be assessed charges, and this could be recorded as a liability. So when you're paying out those share owners and members' shares has appreciated, and then you have to pay them out, then it becomes liability. Otherwise, when you're holding on to as a shareholder and the contributing capital, then it's looked as being equity. All right, retained earnings are equity, and that's what members' shares are. Retained earnings. When some of the earnings are returned to the owners of a co-op is known as a patronage dividend. Does anyone know what a patronage dividend is? That's when you, a member of a co-op, you are accumulating your equity share in the co-op, and it's paid to you as a patronage dividend.
So now can you, what do you do? Reinvest that if you want to leave it in the co-op?
Yes, you can. Yep. And it's only paid out when it's paid out during certain times. Now, if you have it in your bylaws that at the end of the year, after all your assets, all your liabilities are paid on, and you have revenue left over, then you can divide it up among your members. That's a patronage a dividend.
Okay.
Yeah.
But
or
that'll be clearly specified
in your
the bylaws before you start operating.
Right. Or you can retain it and let it accumulate over time.
Okay.
Did you get that?
Yes.
You can pay it out. All right. At the end of after all your assets are paid out, liabilities are taken care of. Then someone's
Yeah, you can hear the background.
yeah. Thank you. What was I saying? Oh yeah. So when you pay it out, I mean, after all your liabilities are taken care of, all your bills are taken care of, then you have this revenue left over. Then you can pay patronage to the members, or you can retain it and let it accumulate further over time.
And is there anything, so it'll specify in your bylaws what how your decisions are going to be made beforehand about things like retained earnings?
That's right. Right in your bylaws.
Okay.
Yeah. And that's where the bylaws really, and we'll have a session on that, but that's where the bylaws really dictate the whole operation of the co-op.
Yeah, the governance process.
That's right.
Well, and there's tax considerations for that stuff, so you have to consider that too.
Yeah, because you will be liable to pay taxes on your patronage as well. Because if you look for you, it'll be revenue.
Right. You mean for the individual member?
Right, for the individual member to be looked at as revenue. The income statement is the organization's financial performance over a given period of time. Examples of revenue, income, member charges, assessments, member fees, annual member dues, interest, and investment income. All those examples of revenue income.
So if you sell a product or a service, is that also, should that not be under income? Under revenue?
If you're selling a product or a service?
Yeah, if the cooperative is selling
Yeah.
a product or a service.
Yeah, because it's generating income.
Right.
Anything that generates income is example of revenue.
Yes. Okay. I just didn't see it listed. I was.
Yeah. No, she probably didn't list all the sources here.
Right, it
just
says examples. I see it
just
now.
examples.
And I had another thought too, because you like a cooperative can be a for-profit or a nonprofit, right?
So true.
And with a for-profit, a lot of these things will, well, I mean, I guess they would be for both, but like for a nonprofit can also have a for-profit, which would be something called fee for services. So that means like if you have a service that you provide, right, under your nonprofit, you're still generating revenue, but it's taxed differently.
Yeah, only thing about the nonprofit revenue, it has to go back into the business.
A nonprofit, right? Exactly. So
Yeah,
it's
it has
like
to go back into the business.
it's like a method of sustainability. So you're saying that you provide these services, so these resources can go back into sustain the nonprofit.
Yeah, if you're a nonprofit, if you're a nonprofit, you can't profit individually off of the profits of the work. You have to invest it back into the business.
Right. Okay.
Okay. Example of expenses, maintenance and repairs, staff salary, wages, depreciation, utilities, interest, insurance, investment in technology, professional services, supplies, education. Those are looked at as expenses. And it can probably go down a little more, utilities, break out your phone, your gas, electric, interest on your bank account, interest on loans, insurance could be divvied up in terms of types of insurance, technology in terms of buying technology to replenish the operations of the business, professional services, supplies, and of course, education and training are some expenses as well.
And even things like interest on your mortgage.
Yes.
Is considered an expense.
Yeah. Yeah, she has interest here, but interest, I'm thinking she was quantifying interest on debt. Example of the balance sheet, the assets and the liability side. So here she's showing $15,000 in cash, $2,000 in accounts receivable, restricted cash, 30,000. Do you know what restricted cash is? Anyone know what restricted cash would be? Example of that?
It is it cash that must be used for a specific designated purpose?
Yes. And land 20,000 and the building 80,000. And so on the asset side, $147,000. On the liability side, she has accounts payable for 3,000, loan payable for 80,000, member deposits for 10, and that's total liabilities is 93,000, and then retained earnings what will be retained earnings? Well, retained earnings is earnings that carried over from the previous year. So they had money already that they had carried over from the previous accounting year. So that is retained earnings of 54,000, which brought up the total liabilities and equity to $147,000 on the liability side. So this is the balance sheet, balancing the total assets with the total liabilities and equity. Let me walk through this again. On the asset side, she's showing cash, accounts receivables, restricted cash, land, and building. Because when you're purchasing a building, you have to separate out the land from the building. All right? Well, in Baltimore, they used to have ground rent one time where people never owned the land.
Right.
But now that law has sort of,
No, they still have ground rent.
Really?
They still have ground rent. Matter of fact, I'm in the process of buying my ground rent right now.
Well, I thought that they passed a law that said that you could buy the land from the landowner.
Yeah, you can. So what regional management did was they bought up as much ground rent as they could. So you still have ground rent, but a lot of people didn't know that you could buy your ground rent.
Oh, okay.
Yeah, so regional management, which owns a lot of the apartment complexes and stuff like that. So they bought up a lot of the ground rent, but you still have ground rent in Maryland, in Baltimore. It's just you got to go through this whole process in order to buy your ground rent.
Oh, okay. All right.
I'm in the process of doing it right now. And the way that they do it, right, is they also use your tax assessment, right, and how much you owe for your ground rent.
Oh, okay. So it has assessed value on the land.
Exactly. So for instance, when I bought my house really, really inexpensive back in the day. So my ground rent wasn't a whole lot. But now people that may be buying houses that's a lot more expensive than mine, the ground rent may be a little bit more. So it's gonna, yeah.
I was under the impression they passed a law to do away with ground rent.
No, what they did was they put at first they put a more, you might be talking about tax sales.
No, I'm talking ground rent.
Yeah, no, they still got ground rents.
Oh, goodness. Okay.
You go to Maryland taxation and assessments and pull up ground rent. They even have like a specific office that helps people to buy their ground rent.
Oh, okay.
Yeah.
Okay. All right. So in this example here, she separated out the land from the building in terms of it being an asset. So.
And Josie had a question about restricted cash.
Yes.
Yeah.
Restricted. Can you please explain that a little bit more?
Well, restricted cash is just cash that you have that's designated for a specific use, a specified use.
Okay.
Yeah. So example that could be a grant that you have, and you only can use it for a certain purpose.
Yes. Or in our situation, like in the church, if people give to a capital campaign,
yes,
and the funds in that capital campaign can only be used to renovate or upgrade the property or to do repairs and maintenance, whatever the campaign title was, and that it said we were going to use it for, then you have to restrict that amount of money to only be used for those things.
Great example, Reverend Burnett. Great example.
Is that like a tobacco grant, Reverend Burnett?
The tobacco grant is a restricted fund.
Okay.
But also, when we do a capital campaign where we say we're going to redo the roof or the parking lot or the doors or whatever we say, then we cannot use those monies for anything, only for what we said we were going to use those monies for.
Mhm.
We can spend it, but you got to spend it on the doors if you raise the money saying that that's what it's for.
Yes.
Or if you got a grant that says this is money for your technology. We got a technology grant. We can only use those technology funds for technology.
Mhm. Thank you. So on the other side of the balance sheet is the liabilities, accounts payables, and those could be payroll account. They could be bills that the corporation has incurred, loan payment. Of course, that could be a mortgage, or some kind of repayment on a secured debt. Member deposits in the co-op, liabilities, again, look at member deposits. And I think that when you look at member deposits as liabilities, it's because of the fact that they come in and they go back out again. And so I'm assuming that's why she put member deposits here as a liability. And total liabilities were 93,000, added with return earnings. Retained earnings are carry over earnings from a previous year. So in this case, if it was a nonprofit, they had return earnings in terms of what they had paid out and what they had retained in terms of overage. So she added that to the total liabilities, and it came up with the total liability and equity. So your return earnings is really your equity that you have secured as a result of your operations. Everyone clear on how this balance sheet is structured with the assets and liabilities?
Yes.
Okay. Well, good. I'm hoping I'm doing a good job of explaining this. And again, example of expenses, maintenance, repairs, staff salary, wages, depreciation, utility interest, technology, professional service. And you can come up with a whole list of expenses in terms of your operations. Expenses could be broken out in terms of education that you receive and education that you're receiving. So yeah. So the income statement. All right. Revenue, member assessments. So that will be like the members' dues and what they assess that. So that would be, in this example, it's $130,000. Interest income is $1,000. So that give her total revenue of $131,000. And so the interest income is the interest the interest income that she's generating as a result of having this member assessment in a bank or some income generating account. And so that total revenue is $131,000. Again, it's the member. In this case, looking at co-op, it's member assessments added with the interest income. So that gives the total revenue of $131,000. All right. Expenses, loan interest, utilities, depreciation, maintenance, education, and come up with the total expenses of $127,000. The net income is your total expenses minus from your total revenue. And that gives you your net income. So here you subtract 127 from 131 and you get the $4,000 net income. Beginning retained earnings, again, is the equity that you bring into the space of 50,000. You add that to your net income, and your ending retained earnings is now $54,000. Let me walk through this again. Revenue. In this case, this example, member assessments. And so that's the member dues, liabilities, etc. And so with that is interest, the interest income, because you got it in an interest-bearing account. So you generate $1,000 of interest on it. So your total revenue now is $131,000. Your expenses are the liabilities that you're paying out. So you're paying out for loan interest, utilities, depreciation, maintenance, education, and so the total expenses are 127. To get to your net income, you subtract your total expenses from your total revenue, and that gives you your net income. All right, so the beginning retained earnings is that earnings that you have carried over from a previous year into this year. So say that, you know, in 2022 that you balance out and you had, after you paid all your expenses, then you had left over, say, $20,000. In this case, it's $50,000. And then you add that to your net income of $4,000, and then you get your ending retained earnings of $54,000. So this is a statement that's looked at over a period of 12 months or accounting period. I do want to make that known. This is a income statement that's looked at over a period of time.
Okay, and the statement the date on the statement should show you the time frame.
Yes.
Okay. And Lynn had a question about depreciation. I was going to kind of ask too, because you have to show depreciation as an expense, but it's not actually a real movement of cash because it's allocated over a period of time.
Right.
Your accountant allocates a certain amount of depreciation against your land and your equipment and your assets.
Yes. Yeah. Not all assets have expenses are depreciable. Right. Mm-hmm. But usually office equipment, furnishings, if you own vehicles, those assets are depreciable assets. But not all your assets are depreciable.
Okay. But you're writing it off. That's the thing. Over a period, every year you're writing off a certain amount of that.
Mm-hmm. Yeah.
Until it's fully depreciated.
And I think it's 26 and a half years, is it? I think it's 26 and a half years that you write depreciation off. It might have changed in the new tax law, but I think it's 26 and a half years that you can write off depreciation.
Yeah, but I think it depends on what you are depreciating, right? Whether it's real estate, whether it's a vehicle. So there's a certain amount of time that you can roll over for depreciation. And with the new tax code, it depends on a lot of these other things. Like if you are in an opportunity zone, if you in a hub zone, and all this other kind of complicated stuff that plays into depreciation too.
Oh, okay.
So your accountant kind of has to figure that up for you.
Exactly.
Yeah,
well,
yeah.
They should know what they talking about, because say for instance, so like in an opportunity zone, if you have an office, because this income statement looks like it's for real estate, for like an office building or something, right? And if your office building or facility is like in a hub zone or an opportunity zone, they get write-offs for I mean all kinds of stuff for depreciation, and it just depends on where you are located. And then other places you may not get as much or as long extended terms of a depreciation. Like some of them may not have to pay taxes on a lot of different things on the buildings because they are in these specific zones.
That's good to know.
Yeah. Yeah. And even expenses, I mean, she doesn't show, she does low interest, but their taxes will be another expense as well. Thank you, Kimberly.
And Josie also asked a question in the chat a little bit ago. She asked, what is considered restricted cash?
We addressed that.
Oh,
Yeah. Yeah, again, restricted cash is cash that only be used for a specific use. Okay, two methods of accounting is the GAAP and the cash. And so you can set your books up versus the cash accrual or the GAAP, which is general accepted accounting principles. Okay, the GAAP method is generally accepted accounting principles, also known as the accrual method. It's used for most formal financial reports, such as audit reports. This best reflects the organization's true economic situation. Revenue recognized when it's actually earned. Expenses recognized when they're actually incurred. So when you earn your income, and you earn it, and then you expense, when you immediately expense it, then that's when you're using this GAAP method.
So now does that mean if I give somebody an invoice and they are supposed to pay me, but they don't pay me and in the time period that they were supposed to pay me, even though I have already earned it, wait a minute, when it's the revenues are recognized when they're actually earned. So that means that even though I don't have the money in my pocket and in my bank account yet, I have earned it because I've invoiced them. You know, they're supposed to pay it based on whatever agreement we have. Is that what that means? When it's actually earned, you recognize, you put it on your books as income when you actually earn it versus when you actually get the money.
Yes.
Okay.
When you actually earn it.
Okay.
So earning it in this case will be at the time that you sign the contract.
Okay. Okay.
Yeah, that's when you earned it, when you signed the contract
versus when I executed on the contract.
Yeah.
Oh, okay.
I'm assuming. Let me just say this. I'm assuming that's what it entails.
Okay.
But again, write that question down, and we'll have Miss Davis go over that, and she'll be on board next couple of weeks. But I wanted to at least just get some of this down today. So anyway, so revenue recognized when it's actually earned, and expenses recognized when they're actually incurred. And so that's what the GAAP method of accounting is. And so versus the cash method. All right. So revenue recognized when cash is received is a cash method. So if it's not received, then it's the GAAP method. So when exchange of cash is done then that's the cash method, because you're actually receiving cash. And expenses are recognized when the cash is paid to the expense. So that's the big difference here between the GAAP and the cash method, is that revenue recognized when it's actually earned, and then here, revenue recognized when cash is received. So if it's received, it's the cash method. If it's earned and it stays on the book, it's the GAAP method. See, so in the GAAP method, you don't have to pay it out. You may want to carry it out for 3 months or 2 months or 60 days. But in the cash method, you immediately, the cash is paid out and it's received. And so that's the difference in these two methods here.
And this is saying that most co-ops use the cash basis.
No, most co-ops, I would imagine, are using GAAP method.
Well, no, her statement down at the bottom there. What does that mean then? Most co-ops budgets and internal income statements are done on the cash basis.
Right. Oh, yeah. Oh, okay.
So that's what she's saying.
That's what she's saying, yeah.
And I wonder about that too. So maybe that's another question for her.
Yeah. Internal income statements are done on a cash basis. So what you make an assumption is that they're paying out as they go along.
Right.
They're paying out as they go along. Versus carrying it on the books.
Right. Right.
And I can see
I can
that.
see that. I can see that too.
Yeah, I can see that being the case.
I can see that now. I can. It's just easier to manage that way.
Yes.
Okay.
Someone asked a question about depreciation, and some assets, buildings, renovation, furniture, equipment are not recorded as expenses when purchased. Instead, they're recorded as assets on the balance sheet, then depreciated over several years in terms of income statement. So on the balance sheet, we carry buildings, renovations, furniture, equipment, all on the recorded as assets on the balance sheet. But then they're depreciated on the income statement in terms of depreciable value on the income statement, because they are being depreciated is income back to the organization. Let me try to be clear with this again. They're recorded as assets on a balance sheet. But when they're depreciated over years, then they come back as income on the income statement. So say that I bought a new desk. So on my balance sheet, I'm recording it as an asset because it is an asset. But on the income statement, it's depreciating because I'm getting return on the depreciated value of the furniture. So I record it on my income statement.
Under expenses.
Under expenses.
Yeah. Yeah. Is it kind of sort of the same thing as amortization? Like when you amortize something, you divide it up into chunks, and then you spread it over every year.
Well, you
kind of sort of,
because you do amortize the depreciation over a period of time.
okay.
Yeah. So it does amortize over a period of time.
We always have that little challenge when we do our annual financial plan, because depreciation is not actual cash that you expended, but it's on your expense statement.
Right. Right.
And if you're
Yeah.
on a cash basis and everything else in there is cash that you can actually, you actually wrote a check for or sent somebody, depreciation is the one thing that's not in that category. No cash was actually put out
Right.
in that amount in that year.
Right. Yeah. So depreciation just spreads out and expenses the cost of those assets over several future years. And that's what it did. It's and it's how you say, how do I put this? It's the numbers game.
Yeah,
That's
well said. It's well said.
It's a numbers game. And when you buy something and you record it as an asset, and then in the same thing on your on your income statement, you record the income on it, but it's not real cash that you're getting. It's the value of the appreciation that you're getting.
Yeah, you're writing it off.
You're writing it off. Maintenance projects per gap, capitalized and depreciate major projects. These are recorded as assets on a balance sheet. Then they are depreciated over several years, and depreciation expense recorded on the income statement. Expense minor projects recorded on the income statement as maintenance expense. Cash basis, often for internal reports, all maintenance projects will usually be expensed. So I'm not sure about this here. Capitalize and depreciate major projects, and then they record it as assets on the balance sheet. I understand that. Maintenance projects can be recorded as assets on a balance sheet. Then they're depreciated. So here they're being recorded as assets on a balance sheet, and then they're being depreciated on the income statement.
Right. That's yeah.
Yeah. And expense minor projects recorded on the income statement as maintenance expense. So yeah.
Okay. So you're taking the full, if you have like a maintenance expense, like you did your floors or something, and it cost you a couple $1,000, you can put that, you can expense that on your income statement as an expense, the full amount. You don't have to depreciate it over a period of time. You just take the whole lump sum in that one year you did it. That's what that means to me. Expense minor projects. Capital projects are major, like you did the roof.
Oh yeah.
You did something big. Okay.
Yeah, I think roofs are roofing and capital replacement of furnaces and things of that nature are they're depreciated over time as well. Yeah.
But if it's a minor project, that is what I'm saying, what I'm understanding. I'm trying to understand. You expense minor projects, you don't depreciate them.
Yes.
Okay.
Okay. She has an example here. I have not looked at this example. But if you want to try to work it out, we can go through it. Okay. Initial situation: by the end of December, the cooperative had borrowed $1 million to develop its first property. Okay. Development costs exactly $1 million. Okay. Okay, so we got $1 million. Okay. So on a balance sheet, we're showing land and building for $1 million, total assets $1 million, loan payable $1 million, total liabilities is $1 million, and liability and equity is $1 million. So that's simply fit, because again, the assets of the building and the land came up to $1 million. So our total assets are $1 million. Our liabilities are loan payable, since we borrowed the $1 million is the total liability on this is for $1 million. And our liabilities in equity is $1 million, because now we're invested in equity of $1 million. So that's very simple. Okay. The corp has 30 units as has 30 units as was full to the start of the year. Members are assessed $1,000 each for the month of January for a total of $30,000. But 2 members didn't pay that month, and 1 member paid their January and February charges. Okay, let's take a look at that. Okay. So looking at on a gap side,
Okay, so
we had we had assessments of $30,000. Remember, everybody was paying $1,000, 30 people. So that's assessment of $30,000 on a gap side. But remember, gap is recorded as it comes in. So $30,000 is what is the assessment. All right. So total expenses is 0. Net income is 30,000. On a cash side, we have 29,000. Why is it 29,000?
because 2 people didn't pay and
One person didn't pay $1,000, right? So they only collected 29,000.
No, if you go back to that slide, Ron, I think it says that 2 people didn't pay and
No.
one person paid for 2
No.
months. That's why it came to 29.
No.
Oh,
See, yeah, members assessment each month of January, but 2
Right.
members didn't pay the month, and 1 member paid their January and February charges.
right. That's why it's 29.
Yes.
I see that.
Mm-hmm. All right, so that's net income on the cash side. So here we're looking at gap, financial record keeping, and cash accrual basis, cash.
Mhm.
Okay. So here we received $29,000 in cash, but accounts receivable is $2,000 because the 2 members, as you had noted, Reverend Burnett, 2 members hadn't paid. The land and building is still $1 million, and so the total assets is $1,031,000. Again, this is the gap side. On the other side, the liability side, deferred revenue is 1,000 because that person didn't pay, so that's coming in at a later time. The loan payable is $1 million. So the total liabilities is $1,001,000. Equity, the net income is 30,000 because it's adding the 30,000 regardless of it collecting. It still says $30,000. That's what the net income is, and then you add the equity to it, to the deferred income, deferred revenue with the net income, so you come up with $1,031,000. So I can see where this is relevant, because the cash, again, on the gap side, the cash is 29,000. The account receivable with the 2 who did not pay was 2,000. And so that came up to $1,031,000. And so we're seeing the balance in the balance sheet here.
And that $1,000 in deferred revenue was the person who paid an extra month in advance. That's what that $1,000 is in deferred revenue.
No.
Two members didn't pay during the month and one member paid their January and February.
Right.
So that 1,000 is the February payment that they received in advance.
Right, in advance.
Okay. Okay.
So so yeah, that's what that is. So that's what that means. The 1,000 that was paid in advance and deferred revenue. Assumption 2, also in January, the co-op purchased $5,000 worth of supplies, which it paid $4,000 by the end of the month, and the staff incurred $8,000 in wages, for which it paid $7,000 by the end of the month.
Okay.
Okay. So assessments again is the 30,000 that we get from members' assessments. Supplies, again, purchased 5,000 for supplies. So this is the gap method now. This is 8,000 in wages. Total expenses 13,000. Net income is 17,000. Now, why is it net income 17,000?
That's 13 from 30 is 17.
Yes, yeah. So you from your assessments of 30,000, you expensed out 13,000, so your net income is 17,000. All right. On a cash basis, the assessment is 29,000 because we're missing again, we have one month that the person's not paying, so that's 29,000. Supplies is 4,000 because that's what we paid out, not what we projected to pay, but this is what we paid out, 4,000, and then we paid 7,000 out in wages. And total expenses was 11,000, and the net income was 18,000 because 11,000 total expenses from the 29,000 assessment leaves us with net income of $18,000. Let's chew on this for a while. Again, on the gap side, we know what gap is. Gap is accrual. So we record it as it is. That's why we record it as it is. So in this case, the 5,000 is what they had expended, had budgeted for supplies. The 8,000 what they budgeted for wages. Even though they only paid 7,000 and 4,000, they had budgeted it for 5,000 for supplies and 8,000 for wages. And so the total expense was 13,000. Even though they did not collect the entire 30,000, but they assessed the 30,000, which minus out the 13 gave us a net income of 17,000. And this is using the gap method.
Right.
On the cash side, we only recording what we get. So we got 29,000. We paid out 4,000 in supplies. We paid out 7,000 in wages. And so that total expenses came up to 11,000, and we subtracted the 11,000 total expenses from our total assessment, which is 29, and gave us $18,000. Is anyone see where she's gotten these numbers from?
Yeah.
Okay.
I can see that.
Yeah.
It appears that you got $1,000 more by doing the cash method than doing it the gap method. But
Yes.
that is because, let me see what I'm saying. With the gap method, you're recording it in terms of what it's supposed to be.
Right.
In the cash method, you're recording what actually happened.
That's right. That's simply put. That's the simplest way to put it.
There's the $2,000 in accounts receivable.
Okay. Yes. So the 2,000 was the amount that the person had paid out the 2 months, February and January. And so the cash, again.
I love the way you said that, Reverend Burnett. It just simplified everything.
Oh, okay.
So the cash was 18,000. So we got 1,020,000. On the liability side, we got accounts payable was 2,000. Deferred income was 1,000 because that's the member who did not pay. It was still our loan payable was $1 million. So our total liabilities was $1,003,000. Our net income year to date was 17,000. And so our total equity is now $1,020,000. I think what is being communicated here is looking at the difference of how you structure your books. Cash versus the gap. The gap is what is the projection of what you have allocated. The cash is what you actually are transacting in the space. And those are two different ways to look at your accounting. One is look at it the gap side or the cash side.
And I think the point is to be consistent. You can't do it one way 1 month and then go back and do it another way.
Oh, no. You can't, no. You have to be consistent. You're absolutely right. Either you're going with the gap method or you're going with the cash method. Yeah.
So which method is recommended?
Well, the recommended method is the gap method because that's what auditors use when they're auditing your organization. Yeah. Yeah, the
That
gap method. Yeah.
It makes sense.
But as Ron, as you said earlier, it's the paper and numbers game.
Yeah.
Your financial planner and your accountant run the numbers out to see how you're going to look one way or the other on paper. By the time the thing is over, and then they make a decision which way you should do it.
Yeah. Yep. So yeah.
Good.
Yep. So I hope I was able to explain most of this to you this evening. And I'll make this available to you as well, so that you can have it to go over. And when Miss Davis comes into the session, then you can ask her the questions that I could not answer. And hopefully she'll answer and guide us in the right direction. So. Yeah. Any other questions, comments?
Well, my comment would be, although unless you're an accountant or a bookkeeper, you probably won't be doing these yourself, but it's important to learn it yourself, so that when you look at what they give you or recommend to you, you can have some knowledge about it for yourself and make good decisions on behalf of the group.
Yeah, that's really what the basis of understanding really is based on, having a sense of determining, being able to determine what is the best method that you want to use in terms of your bookkeeping.
Yeah. And so that as members, we can be accountable. I mean, you know, as members, you're going to be voting and making decisions. You need to know how to read the statements that they're giving you.
That's right.
So this is good. I think this is good.
Yes, that's right. That is so true. That is so true.
But it seems like maybe in a lot of ways, the gap method could be inaccurate because, say, members don't pay for a while, or you're not, you know, the numbers could be inaccurate in terms of how you really look on paper. But I guess because audits assess you in that way, you know, it makes sense to use that method, but it seems like it could be a little inaccurate.
Well, if you don't collect, you're right. If you don't collect
Collect
it, yeah, right. You carried it on from.
I guess you're carrying it on somewhere, but
right.
yeah.
You carry it on from year to year.
Yeah, your balance sheet is going to show up with all those payables.
That's right, payable.
Money, uncollected money.
Right.
That's what it shows up.
It's not inaccurate. It's all the uncollected money that I was thinking about. Yeah.
Yeah.
But don't it eventually balance out? Because from my understanding, if we're doing the gap and you're saying we're putting down totals that we assume that we're paying out and not actually paid out, but at some point in time, for filing tax purposes, you're going to still have to record what you actually paid out. It wouldn't be something that we would still ride to assumptions. Then it balances itself out. So you're going to have to put down, okay, this is actually how much I spent. This is actually how much I collected. Even if you're estimating or assuming when you're doing your bookkeeping. But at the end, it's going to have to be something that is going to make actual totals.
But still, you're still carrying it. If it's not paid, you're still carrying it on your books as a payable.
Correct.
Yeah, that's the key to with the gap is that you're still carrying it on your books as a payable, and then the payable becomes a liability.
Right. So that's why I was saying that then at the end somewhere it becomes an actual figure, whether it's a liability or a payment. So you know, it turns at the end of reporting. I guess I want to say that at the end of reporting, like when you're filing your taxes or whatever, it becomes one of those entities permanently.
Or it shows up as a loss.
Correct.
Yeah.
Okay.
Yeah.
Yep.
Then another thing I was thinking, it probably is a software. I ain't no expert in tax, but it's usually software. Like you said, however you're starting off your bookkeeping, you know, depending on what type of software you get and how it is designed, whether it's designed for the gap method or actual method, is where you want to determine what that software is doing. Because most softwares are so user-friendly, it will pull the totals for you as long as you're entering the right information.
Right.
Year after year. So it just, just take that data from last year, pull it into this year and adjust where we need to be adjusted based on how those programs are set up.
Yeah.
I think it's worth just at least having a bookkeeper periodically if you're not going to be able to retain one, regularly. It's just probably a good idea when you're dealing with a lot of people. I found this out from church management. When you're dealing with a lot of members and their money, when you can give them the confidence that it's being managed well, then they take that off. They don't have to have their minds on it all the time, and they can be about the business that the business is about. They can be about the business that the ministry is about. They can focus on the kind of things that we want them to be focused on. So it gives people confidence. Sometimes it just gives people confidence to know you got a qualified bookkeeper, even though it is something you could do yourself, probably in startup. But sometimes I find people are more comfortable when they know you have a person who knows accounting, who's at least giving you some oversight on a regular basis.
Yeah, just add something, Brother Ron.
Yes.
Brother Ron.
Yeah, go ahead.
Oh yeah, I was just gonna say that also, you may recruit a member who is a bookkeeper. You may have a board member who's a bookkeeper, right? So I think, you also, the idea you want to train your member workers to be able to do many of those things. And then a company definitely would think about cooperative accounts, right? But a bookkeeper, I just keep realizing when I tell them, they don't have to say, like, you need to get to a certain size. Because this is something I can teach you to do. I can set up your spreadsheets, right? And in fact, we have been also, there's a bookkeeper cooperative, they're a cooperative group, and they do a lot of trainings and they can set up your books. But one of the things is that's one of the things that your member want to do too. It's also, sometimes they're doing whatever the cooperative business operation is, but then they're part-time bookkeeper, right? So those are just things that you can create revenue within the organization. So always finding people who have that financial background, at least to be part of those founding members of your cooperative.
Yeah, that's good.
Yeah.
Look for the resources within first.
Right. I just want to add this again. This is Krista. And the reason why I said still, everything is based on information. So if you would get, again, your own software, because the bookkeeper is only going to be as good as the information they receive. So you still need to get a structure where you're putting your information in and have it organized. So even when you give it to the bookkeeper or whoever's doing your taxes or whatever, they can have a more clear cut portfolio of where all of those transactions goes. Because a lot of people get confused. They'll bring you a box of receipts in a box and say, here, bookkeeper, figure out my stuff. That's not how it works.
No, indeed.
I want you to have all that stuff organized and all
I have a question.
those different categories. So as they, again, they can do that. Go ahead.
If let's say you're fortunate to have a qualified bookkeeper, I recommend having one, but let's say you're fortunate to have one. Now, how often would you suggest to have an in-house budget meeting?
Are you still there, Marvin?
How often would you suggest to have an in-house budget meeting, a meeting in regards to financing?
Well, I would think on a monthly basis that you're covering your financial reporting on a monthly basis.
And even if you didn't meet on a monthly basis, it definitely should be on a quarterly basis, because sometimes people pay their taxes quarterly, so they won't get the big bang at the end. So you may want to meet quarterly just to make sure that you have your tax situation in order, how much you would have to pay in taxes.
That
Yeah,
makes sense. That makes sense. And
and
you, go ahead.
no, go ahead, Marvin, finish.
No, go ahead.
No, I was just gonna say, too, is that I guess either starting out, um, because you have to make sure that your bookkeeper or accounting person is also familiar with your
Operation.
Your operations.
Yeah.
your corporation, because for instance, my sister-in-law has a tax organization, right? So she has a tax business, right? And so that's how I know some of these things, because I ask her a whole bunch of questions all the time. And when she first started out, she was doing nonprofits. And now she has decided that she has cut back on that because nonprofits take a whole lot more time, right? So I'm saying all that to say is that just do some, not just your homework, but interview different companies and organizations to see what their expertise is and what they like to do. Because every bookkeeper or every CPA is not fit for your organization to do the work. And they may say it, but you need to, like what they say, get some receipts. Like, I need to see some receipts, like, because
Right.
it's dealing with different entities, and with them always changing the tax code, is that they are more likely to audit little people than they are to audit big people, right? So you got to always make sure your I's are dotted and your T's are crossed, and
Yes.
all that kind of meticulous kind of thing. So whoever is going to be handling your finances, to make sure they are in alignment and understand, and not just know your mission, but know where you're trying to go, that you can all be on the same page.
And also reputable.
Yes.
Just like we intend to interview our employees, they, I would recommend or suggest interview them. They should have a resume, right?
Yeah. And a capability statement.
Right,
Who
right.
they've served, who they worked for, what they've done. Yeah. I agree. We actually have our bookkeeper produce financial statements every month. And we have a team of people who sit down every month and just look at it and go through it. And it's one of the principles of the co-op that I love is the continuous training part. So I think you should always be training new members to understand the finances of the co-op. Just as a regular, consistent, if it's once a quarter, having a training on something or just whatever, so that the members are intelligent and conscious when the decisions start getting made. And when the action gets fast, you don't want people lagging behind and can't keep up because they didn't understand the language or they didn't understand how you operate or whatever. So if you just have a continuous educational process built into the cooperative, people will understand that.
Right. And then also too, you see a lot of organizations that go under. Why did they go under? It's because of the finances. And then you have people say, well, I didn't know this was happening. I didn't
Right.
know that was going
Right.
on.
Like, too late
Like,
then.
right.
Too
So,
late then.
that's just a way of keeping people engaged and informed, especially when it comes to the money. Because when it comes to the money, look, if the organization or business is not generating revenue or finances, or being a part, or what the mission is called, because I don't care if you're a nonprofit or for profit, right? It's all about the money at the end of the day. So you got to keep your finances and those kind of things in order to keep your organization going, regardless
Yes.
to what kind of entity that you call yourself. And a
I
lot of
agree.
times people think because you're a nonprofit that you don't make money. No, nonprofit just means that's the way you identify as your IRS tax code. But I know plenty of nonprofits, they don't quote unquote make money, but they getting a lot of money. Did you know the NFL was a nonprofit? Did you know that
Yes.
the Red Cross was a nonprofit?
Yeah.
You understand what I'm saying? So it's a business, but it's a specific definition or how they define a business. But it's not like they're making money, but they're defining a tax code in a different way. So a nonprofit is a business. It's just a non-taxable nonprofit.
Yeah.
That's all it is. So I like to say that out there because sometimes I'm gonna just say this, we as Black people think because we serve the community and we got a nonprofit and this, that we're not supposed to be making money. That's absolutely not true. No, we're supposed to be making money.
Yes.
That's the way that we define, and gotta make sure that we got all of our I's dotted and our T's crossed, because guess what? They are gonna be looking at us with a microscope.
Yeah.
So
And we want to do that for ourselves. I mean, you know, whoever they are is going to be looking, but we want to do that for ourselves just so we have some integrity.
Right. And I need to know I need to know, and I think it's good for all of us, right, for our integrity, but also to know how is it that we continue to build generational wealth, right? Because that's what we're looking at when we talk about, right? So how do we look at continue these nuggets, like I like to call, I'm gonna call them green nuggets. How do we continue these green nuggets so that we pass these kind of things on in generational wealth to our children? A lot of things that we are learning as adults, we should be teaching also to our children as in the financing and how we build and how we keep resources, not just in our community, but also in our families.
Yes, yes.
Yes.
I agree.
I agree with that. Okay. Okay, good. All right. Any more comments?
I learned a lot tonight. Thank you, Ron.
Oh, goodness. Well, thank you. Thank you.
Yes.
Well, I tried my best. But we'll have Miss Davis come. She had a obligation, so at the last minute. So instead of just counseling it, I figure I just try to plug away at it. So
Pinch it. Yeah.
yeah, so pinch it for it.
Yeah. Well, we're all doing this together. You know, we're learning together. So may as well start now.
Yes.
Yeah, can I ask a question? Do people have specific cooperative accountants that they're working with or have worked with?
I thought I didn't hear your question.
I was asking, did people have a cooperative accountants that they had worked with, that they had good experience with, or they're working with?
Did anybody hear a question?
Yes.
Oh, okay.
I did. Well, you know, the more I look at the cooperative structure and the principles behind it, I recognize that our church is organized as a cooperative with members who vote and, you know, teams of people who do it. The only thing that we don't do is, you know, we don't, you know, well, our product really is our classes and our, you know, we're a teaching ministry. So in studying, learning about cooperatives, I'm interested in building a cooperative, a wellness cooperative, wellness modalities, actually. And I'm noticing the parallels, the similarities in
Mm.
how we structure it and what we do. So I don't have the experience of a cooperative per se, but I'm learning quickly that some of those elements are already in what I've been doing.
Well, mutual aid societies and with a forerunner of cooperatives, mutual aid society, where people mutually came together and set goals and worked on initiatives together. They were the forerunners of cooperative mutual aid societies, and which started with the church.
Yeah, those lodges that you talked about. As a matter of fact, there's a woman here in our church who is the president of a 150-year-old Black lodge that had the first Black schoolhouse in one of those counties, I want to say, over in the White Marsh area. That was structured as a cooperative. There were members from the very beginning, and in 150 years, they've managed to keep operating. They operated pretty much under the radar, as so to speak, so that you didn't know who they were accumulating and giving money to for things like educating their children or burying people or food or whatever it is. But I just recently found out that they had been operating this cooperative, this lodge, this Black lodge for 150 years.
Goodness.
As you say that, Miss Burnett, I was thinking, can you, and maybe this is a question we can ask the financial person, or maybe we could ask a lawyer. I don't know who we ask, but just ask somebody. This question: can you operate a cooperative in a trust?
In a trust.
So what I mean is, because when you mentioned that nobody really knew who was in the cooperative, a lot of times is that people incorporate a trust, right, that has people in it, but you don't know who actually owns the trust.
Oh, yeah.
You understand what I'm saying?
Yeah.
So that's just a thought that came to my mind when you said nobody really knew who was in the trust. So.
Well, in this case, it was that nobody knew who the recipients were. The members were everybody knew could know who the members were, but they were not making it public who they were serving in the community. Although, word of mouth, I'm sure people found out. But I think your question is a good question about the trust.
That's fascinating, because if we could do something like, and I'm saying this is because, see, my mind be going to all kinds of places, y'all, right? So I'm in the process of doing a whole lot of creating generational wealth, right? So I'm in the process of doing a trust, right? And so I have an attorney who's helping me do all this stuff, because I found out working with people who don't look like us, right? It's how they be passing on. Don't pass it on the taxes and all that kind of stuff, right? So I said, okay, well, I need to do that myself, right? So that's what I'm in the process of, right? And so when I'm talking to my attorney and she's telling me how to do all these things and stuff, right? I said, oh, that's how they do that. And she's just like, so that's why I said that, because I'm just fascinated about how we can structure ourselves without always being identified, like who, the what, when, where, and why, and how. Because sometimes we got to go under the radar. So sometimes people don't even know who we are until they need to know who we are.
That's right.
You understand what I'm saying? So that's why I'm asking these questions, because my mind and my brain. And see, Ron, I'm glad you have these things like at 6:30, because I'm like a night person, so my mind starts thinking about all the other kind of things. So, like I'm all over the place, but I have structured chaos is what I like.
Ordered chaos. I got it.
I'm chaotic sometimes.
It's called consciousness.
Yeah, I know where I'm going at. So, I got to switch brain sometimes. So anyway, that's just my thought. Okay.
It's a stream of consciousness.
Well, my grandson just walked in the door, so he gets a lot of that.
Yeah, the universe does not operate in ABC order. Pure syncopation a lot of times. Circulation and syncopation and
Elizabeth has her hand up. Go ahead, Liz.
you're muted, Liz.
Yeah, sorry about the background noise. I was just gonna say accumulating a list of Black accountants that with co-op experience would be incredibly valuable because there's very few of them across the country. And so it's one thing the association could really, and lawyers and all the other professions, you know. so
Oh,
we can do
yeah,
referrals.
yeah. We're having a discussion at the conference with HBCUs. Well, we reached out to the 6 Black HBCUs and hopefully we got one, and I think we got 2, maybe 3 of them committed to come and share, you know, how they can work to develop more work around solidarity economies, co-ops, and how they can bring their legal knowledge as a university out into the community.
Mm-hmm.
Yeah.
That's a good resource, actually.
Yeah. Because as Liz said, there's not a lot of Black folks out here who working in this co-op space, either as accountants, lawyers, the main 2 bodies that we do need, accountant and lawyers, and of course co-op developers, you know. But yeah, we just don't have a lot of people of color that have learned this work. Yeah. Wow, this is turned into a wonderful dialogue.
Yeah.
Exceeded my expectations. Because I was okay. Let me try. Okay, great.
I'm expecting great things.
All right.
I'm expecting great things.
All right.
Great things.
Oh, goodness. All right. Well, we got about 15 minutes to go. If no one has anything else they want to share, we can take this 15 minutes back to ourselves. All right. Is there anything else anyone wants to share before we sign off for the evening?
No, I would just say great convo, great learning. I'm learning so much. So I just want to say thank you.
Yeah, Elizabeth.
That's a good idea.
It's a good idea.
And just to confirm, we're gonna get the slide deck, right?
Yeah, that's a good idea.
Yes, we do get the slide deck, right?
Yeah, you get the slide deck.
Okay.
And the recording.
Okay, cool. Very good. This has been a good session.
All right. Well, let's leave it on that note and let's get ready for next week. We have a marketing person in the space next week to go over marketing. So yeah. So
good. Very good.
And Anna, you want to just who we have next week?
LA Simmons. She's she works with the Georgia Co-op. I think she's the co-executive director.
Okay. All right. Well, great. Good. All right, folks. All right. Well, with that said, I'd like to share this thought, and everybody have a great evening. It's been a great session. If you have any pop-up questions, please feel free to email me. And I look forward to seeing you next Thursday this time. All right.
Great session. Good night, all.
Good night.
Blessings.